How does exchange rate appreciation impact businesses? Imagine waking up one morning and finding your country's money suddenly worth more compared to other currencies. That's what we call exchange rate appreciation. It might sound like good news, but it actually has a lot of effects on businesses. Let's explore what happens when a country's currency gets stronger and how it influences the way companies operate. When a currency appreciates, it becomes more expensive for foreign buyers to purchase goods and services from that country. For example, if the US dollar appreciates against the euro, European customers will need to spend more euros to buy American products. This makes US exports less attractive because they cost more in foreign markets. As a result, American exporters might see a drop in sales and export volumes. Studies show that exports can fall by about 23.5% after a 10% increase in the value of the dollar. This change happens pretty quickly, often within a few months, as businesses adjust their strategies. On the flip side, businesses that relying on importing raw materials or components benefit from a stronger domestic currency. Cheaper imports mean lower costs for manufacturers who buy from abroad. For example, a clothing company importing fabric from overseas will pay less when the currency appreciates. This can boost profit margins, but only if the company can sell enough products domestically or in other markets. If export sales fall, the overall benefit might be limited. Financial institutions also feel the impact. Banks that have lent money in foreign currencies might face challenges if the foreign currency appreciates. If a bank lent money in a weaker foreign currency and that currency then appreciates, the bank might struggle to get back the same value when converting payments back to the home currency. This can create balance sheet problems and even financial instability if not managed carefully. At the national level, a stronger currency can slow down economic growth. Reduced export demand means less income from foreign sales, which can hurt the overall economy. Imports, however, become cheaper, so consumers and businesses might buy more foreign goods. This shift can lead to a worsening current account balance, which measures the difference between what a country earns from exports and spends on imports. Over time, this can lead to a decline in the country's savings and investment levels. The effects on the economy are not uniform across all sectors. Export-heavy industries like manufacturing and agriculture often suffer the most because their products become less competitive abroad. Meanwhile, sectors that compete with imports, like retail and domestic manufacturing, may benefit temporarily from lower input costs and less foreign competition. This can cause resources to move from export sectors to import-competing industries, sometimes leading to job losses in export-oriented areas. Businesses also need to plan for the long term because currency appreciation can last for several years. Companies might consider relocating production to countries with lower costs or shifting their focus to higher value products that are less sensitive to exchange rate changes. For example, a company making basic electronics might move toward producing specialized or luxury items that are less affected by price differences. The reason a currency appreciates can also influence how businesses respond. If appreciation is driven by genuine economic growth or productivity improvements, it might support long-term stability. But if it results from speculative investments or monetary policies disconnected from economic fundamentals, the negative effects on export businesses can be more severe. In the end, appreciation creates winners and losers across the economy. Importers and consumers benefit from cheaper foreign goods, while exporters and sectors dependent on international markets face challenges. Companies must adapt by adjusting their prices, shifting markets, or changing supply chains. For financial institutions, managing currency risks becomes essential to avoid losses. Overall, understanding these effects helps businesses prepare better for changes in the exchange rate environment and make smarter strategic decisions.